thank you so much for joining us today. This is the first time we've run a session over lunchtime. So we're trying to work on finding the most appropriate time that works for people to come along and join us. So if you've got any thoughts on what times work, please let us know. You'll see at the bottom of the screen there is a wee Q&A function. So feel free to use the Q&A to pop in any thoughts and comments as we go along. If you do have questions, we'll answer them as we go. Thank you so much for the people that have already sent through some questions. We do have those weaved into what we're going to be talking about today, and we're certainly hoping to answer the questions that you have submitted as well as the ones that you asked today. Just a couple of things, just housekeeping things for you. One reminder is that this is not personalised advice. It's just information only. So it really is about helping you be informed with what's going on around markets and how that is influencing or impacting your KiwiSaver. I'm delighted today to be joined by both Marcus Wild and Sean Hannigan. They're both going to be talking alongside me. I'll be asking your questions, they'll be answering them. And as I said, I'll be keeping an eye out for questions as they come through. What we thought we would do to start with is I'm going to hand over to Sean. Sean's got a couple of slides to take you through. Markets have been going through a really challenging time. It's a really funny time in markets. They've been running very hot for a long time. And often when markets are running so hot, you can have some causes for concern around, is it really viable? Can it really run this way forever? And should we be thinking differently around some of the investment strategies that we have in place? So Sean's going to take you through those points now. And so I'll hand over to you, Sean. Thanks very much.
Okay, thanks, Sharon. Yeah, good afternoon, everyone. So I'm going to sort of break my little summary into 5 areas. I'm going to talk a little bit about markets, talk a little bit about the AI boom. Is this something which is sustainable? Is it a bubble? There's a bit of a debate around that. Just what are the risks at the moment? There's talk about risks. What's our thoughts around those, what they could be, and what we're doing to mitigate. And then talk about how we've managed our diversification to try and mitigate some of those risks and where we've seen some opportunities beyond AI. So markets, the current markets, I've been in markets for over 30 years now, and I've seen these rallies, and this is up there with some of the best of them. I was a floor trader back in the 87 crash, and that was pretty euphoric, but I think what we're seeing now is sort of on par with that. So AI is driving everything. It's driving investment, it's driving share market performance. You saw in a video today, it's gone through 5 trillion, the first time a company's ever done that, on the back of some announcements coming out of China with Trump allowing the chip to go into some of the Chinese market. But that is really driving AI, and I'll come back to that in a second. But there's some other things going on. One is the expectation that interest rates are going to come down. Trump's been jawboning power to try and get the US Federal Reserve to drop their rates to help the US economy. And the Federal Reserve had a meeting yesterday where they dropped rates by 25 basis points, but Chairman Powell was very cautious about any further reductions. And the reason he's doing that is because inflation is remaining elevated. It's not coming down as quickly. If anything, it's starting to go up again. And the same thing happened in the Australian market yesterday, where rate cuts have been put on hold in the Australian market because inflation's starting to get up again. And this has been driven partly by tariffs. So these tariffs are weaving its way into the market as well, creating this inflationary tension, which is creating a problem. And the last thing you want is very low growth with high inflation. It's called stagflation, and that's a sort of a really bad thing, especially when there's a lot of debt. So Trump is out there driving markets. He likes to be the center of attention. He's having a great run at the moment because he's out in Asia doing deal making. He's a peacemaker. Everything's going well. And so markets have been quite positive on the back of that. There's no sort of nasty tariff stuff coming out. Although I did have a bit of a chuckle when the Canadians released the advert about using Ronald Reagan to say negativity around tariffs, how he then sort of whacks some tariffs back on Canada. So it's his favourite tool to punish people he doesn't like, but it's not really good for markets, and it has real world impacts. So the other thing that's happening a little bit in markets is gold has had this rally, which hasn't had this sort of rally since the early 70s. And what's driving that is, I think markets are starting to get a little bit worried about the reserve status of the US dollar. There's a sort of Trump is impacting the rule of law a little bit in the US. They're also a bit worried about the amount of debt coming out of the US. Plus, there's a sovereign state like Russia that can have their reserves taken in a moment of conflict. They're thinking, well, we buy gold, we hold the gold, that's the store of value. So gold's had a massive run up, as has silver actually on the back of that. And some other sort of mining stocks, copper, uranium, and that's on the back of electrification, right? So it's a pretty narrow market. And I'll come to that when we talk about risks at the moment. There's very few things driving it. Now, are we in an AI boom? There's a lot of noise around this. We're comparing what was happening with AI with the dot-com back in the early 2000s, late 90s, right? Where the internet was going to change everything. Valuations went nuts. If you just had .com in the name of your business, you traded at massive multiples. And there is some similarities with that. The big difference, though, is that businesses today are making lots of money. These companies exposed to AI are actually generating a lot of cash flow. So it's not like these businesses are worthless, but our concerns are these companies going to get a return on the money that they're spending? They are spending trillions on building infrastructure, data centers, etc., to harness this boom. And I saw some research the other day that said by 2030, these investments need to be generating $2 trillion of revenue to justify what they're spending. And there was an 800 billion shortfall. So that's the concern. Are people getting carried away and over-investing? Now, as a bubble, take an OpenAI, which is the poster child of AI, the ChatGPT founders. So they raised some money back in March, which valued the business at 320 billion US dollars. They sold some more shares early this month. So 6 months later, it was now valued at 520 billion. So that's a company that's almost doubled in 6 months, and it's losing $11 billion a year. So for me, that I like finding being paid for taking risks, and I'm not sure I'm being paid for taking that risk. It just seems getting a bit frothy. The other point is a lot of these tech companies, Microsoft, Google, they didn't have a lot of assets. So their return on investment, return on equity is very good. They're now spending billions building these big asset bases, building these data centers. So ROI is going to be a lot more challenging going forward. So the nature of that business is changing. So that for me is a risk as well, right? The other problem that I have, Aurora Capital, we're concerned about the environment. We think climate change is a risk that needs to be managed. We think you can make a lot of money out of it, nonetheless. But so we're doing it for profitable reasons, but also where we think we need to protect the planet better. And AI has a real environmental impact. So my request to you is, you have a simple request: use Google. Don't use ChatGPT. It's much more environmentally friendly. So corrections, right? Are we going to get a correction? So look, as I said, I've been around for a long time. I've seen these sorts of markets before, and I personally think that things are getting carried away. I think basically since 2008, it's been markets just keep going up. There was that big downdraft during COVID, but it recovered straight away. So there's a whole generation of investors that have grown up with this mindset that markets keep going up. You buy the dip, and retail investors are a big part of the market now. I think it's valuations. Now, I've got a couple of slides I want to share on this. So for me, the way we think about it at Aurora Capital is like we like to take risk when we're paid to take risk. I'm not sure in some of these areas that we've been paid to take risk right now. Let me just bring up these slides. Here we go.
And actually, just while we're waiting for that slide to come up, it'd be interesting for you to maybe go through, when you're talking about being paid to take risk, it's really about the return back to the investor. So are you really going to get the return that you expect, or are you going to get the downside risk alongside of that? So helping go through that and explain what you mean by taking on board those risks would be really helpful.
Yeah, so if you look at, let's say, like current markets, can you see that slide there?
I think you might just need to pop it into presentation mode. It's just looking a little small at the moment.
Okay. How's that?
Perfect.
So we're not talking about being paid for taking risk, right? You're always taking risk. That's the nature of investing. But what I'd like to do when I take risk is I'd like to look at the upside versus the downside. And so if you look at the slide on the far left, it's got the valuation. So this is price to earnings, which is a pretty standard measure of market expensive cheap. And what it says is about how many years it would take you to be paid back in earnings. And typically the US market has traded between 14.5 and 18. That's the PE multiple, right? So that blue box is 50th percentile. It's remained in that 50th percentile. These lines with the little dots is where the market's traded in between the 10th and 90th. So 80% of the time it's traded in there. This is where it's currently trading. So it's trading at a P of nearly 23. All the research shows that when you buy shares at that sort of valuation, the return you get over the next 10 years is very disappointing, in the order of 2 to 3%. So if I'm an investor, a rational investor, I'm thinking, okay, so what's the upside versus the downside buying US equities? Looking at this, I'm going, the upside is, the market may become more expensive, but probability-wise, there's a much greater chance of a drawback than there's on the upside. So the upside-downside ratio is not, for me, justifies taking risk. Now, in our growth fund, we've got 48% in the global equities. So effectively, we've got a big exposure to US equities. So we're not going to take ourselves out of the market, but we just go underweight. So we put some risk into other areas where we think that risk-return ratio is better positioned. So one of the big concerns I have at the moment is valuation. Now, there's arguments made why, the index is quite different. You've got a lot more tech companies in there, so it should trade at a higher multiple. But nonetheless, this is still very, very expensive. So that worries me. The other thing that worries me is concentration. The one free lunch you get in investing is diversification. And what's happening at the moment is that funds are trying to outperform other funds, are chasing the expensive asset classes. They're putting more into US equities, more into the Magnificent Seven. And that creates real risk, especially when the concentration is all on a single theme, i.e. AI. So now if you look at this, the one on the left shows the global share market. The US is now 65% of the global market. Not that long ago, 10, 15 years ago, it was 40%. So the US market's become a bigger and bigger of global equity portfolios. At the same time, within the US market, the top 10 companies are close to 40% of the index. So if you take a passive exposure to global equities, you're going to get 40% of 65% in 10 stocks, all related to AI. And that, for me, is just incredibly risky. So it's breaking the fundamental rule about investing, which is about diversification. So that's the only two slides that I wanted to share. But let me just keep talking about some of the other issues that we have. So markets expensive. They're very concentrated, right? So if something goes wrong, like you get the Chinese are developing some really cheap AI models. This DeepSeek really did sort of upset the apple cart back in February, and that's been forgotten. So I just have concerns about the fact that there's too much hype in this market. If something goes wrong, there's no defense in terms of valuation. There's other stuff happening. So tariffs remains a threat. Everyone's come back and think tariffs not a problem because we had, they were up to 140% for China, now they're back to more manageable levels. But nonetheless, tariffs are the more elevated they've been for a long, long time. That's inflationary. And that means interest rates can't come down. And the markets are hoping interest rates will come down. Debt, while not a problem today, is becoming a problem. There used to be a rule, Reinoff and Rogoff did this seminal study back in the 90s that said, once government debt to GDP goes over 100%, it starts to impact growth. The average debt in the OECD now is 120%. And there's no appetite to cut deficits. So the US government's running a deficit of 6.1% of GDP. That is a deep recession type deficit. It's not a deficit when you're in the middle of a boom. And there's no appetite to cut. The Republicans don't want to raise taxes. The Democrats don't want to cut spending. So I'm worried about debt. I don't know if that's a problem next year or even 5 years down the track, but it's going to be a problem because the government starts spending more money servicing their debt than they do in investing in the economy. And that creates a problem. And the other thing that's happening is, this is another thing why I think gold prices are starting to get elevated, because people are worried about whether the government's going to be able to honour their bonds. And the long end of the curve, sorry, getting a little bit technical here, but the long end of the curve, when the central banks are dropping short ends of the rate, that tends to come down as well. It's not. It's going up. So rational investors are saying, okay, we can lend you money for 10, 15, 20 years. We need to be compensated for that additional risk. Geopolitics. I've never seen a market where there's so much political risk out there. This war in Ukraine, there's Taiwan, there's North Korea. I guess we've always got them, but it remains the market's just ignoring this. And it's interesting, there's a bit something going on in crypto. I don't know what's going on, but Bitcoin's gone from 125 down to 110. We don't invest in Bitcoin. I don't think like investing in an asset where you can't determine value. I don't know what's fair value for Bitcoin, but nonetheless, it's something happening there, and I don't know quite what that's about, but it's another risk factor. And what typically sets off markets are these things that come out of left field. People talk about credit problems. We don't think there's a credit problem, but nonetheless, the market's getting a little bit fraught. So how do we mitigate against these risks, right? So the first thing is diversification, and we bought back our exposure to global equities, and we're just making sure we've got other things in the portfolio that are not being driven by AI. So if there's an AI correction, we don't all go down with that. And one of the things about diversification, which I think people struggle with, I'm very happy that my New Zealand equities, my global listed infrastructure, isn't going up by 20% a year. Global equities are doing that. You don't want everything going up at the same time, because that tells you you're not diversified. So I'm quite happy some of my assets not going up as quickly as global equities. And the argument is, you should have the global equities because it's going up. No, it's about diversification. So this is what we're trying to do here. So I think, it's important to understand what diversification is, and how we look to diversify is not only in the asset classes that we invest in, but also in the types of managers that we use. So in our global equities, we've got 3 managers. They all do different things. We don't expect them all to outperform at the same time, because one of the managers, like Brandywine, is a value manager. We expect them to do really well when markets fall. That's how we try and diversify. So just very quickly, just to wrap up, Sharon, before I pass over to you. So the areas that we're finding some value is in global listed infrastructure. So we have a close to 5% exposure to that. And global listed infrastructure has an underlying exposure to energy, a lot of utilities in there. And as part of the whole demand for data centers, the demand for power has increased exponentially. For the first time in 40 years, demand for power has gone up in the US, and it keeps going up. And so a lot of these utilities provide power. So we think that's a good theme to play. And it's nowhere near as expensive as, it's as cheap as it's been relative to global equities for a long, long time. The other area that we've actually been a little bit overweight is New Zealand equities. And New Zealand equities has had a pretty tough time in the last 3 years, because the New Zealand economy's been had a pretty tough time. But with interest rates coming down, currency falling, we think the New Zealand market's actually looking interesting. And the New Zealand market has a lot of utilities in it. Utilities tend to be proxies for bank deposits. So when people aren't getting the returns from bank deposits, they start to move it into these utilities. So we should get a bit of a recovery in that. So we're overweight that. And we've also got private credit, which is an unlisted, instead of banks lending to companies, we give monies to a manager that then lend to these companies. And so it's providing important finance to small New Zealand businesses, and it generates a very competitive return over cash. So we see it as a risky asset, but it'll do well when listed markets fall. So we've created this diversification in the portfolio, but still generating very solid returns. And so, look, I think that's a brief summary of what I want to say. I'll hand back to you, Sharon. Anything that I've missed, please shout out.
That's been really fantastic, Sean. Thanks very much for that. We do have a question coming in that I'll just ask at a moment, but just a reminder, everyone, if you do have any questions that you'd like to pop through, there's a wee Q&A button at the bottom of your screen. Your questions are only visible to myself, so no one else can see your questions and no one else can see your participation here today. So please feel free to pop through anything that pops up for you. One of the things that's kind of, I guess, is always kind of emerging and is popping up for investors, and one of the questions is about, there is a lot to be concerned around markets at the moment. So what's the flip to that? Because markets are performing well, they are delivering great returns. So even though you're acutely aware of taking some of the heat out of it, the returns that we're seeing in portfolios are, from my perspective, exceptional for the time that we're in at the markets at the moment. So still there is a lot to be positive about in investing, and investing for the long term. So how do you help people kind of reconcile those two opposites, really, where there's a lot of risk, but it's still the right time to invest?
Yeah, I mean, it's all about time horizon. If you're in a growth fund, your time horizon is 15 years plus. So, even if markets are expensive today, if you hold those shares over 15 years, the 95% probability that you'll make money, you just won't make as much as if the shares were really cheap. So what you do, and it's about remaining invested, and let us as the professionals try to manage that risk within the portfolio. So I take money, a little bit of money away from the really expensive areas and put some more into the defensive areas. Well, when I say defensive, not as expensive, like I talked about globalist infrastructure and New Zealand shares. So it's remained exposed to the market. The other benefit is this dollar cost averaging. If markets do fall and you're putting your money in every month, you get to buy those shares at a cheaper price, and that's the importance. I want to really stress this, the importance of staying the course. The last thing you want to be doing if you're a growth investor is to ride this big upswing, have a big fall, panic, take your money out, put it into a conservative fund, and put it into cash, and miss that rebound. It's just the importance of that can't be overstated. So it's hold your nerve. And what we try to do, the motto that we have is smooth the journey, same destination. So when markets are running hot, we don't do quite so well, but we try and manage that risk so we don't have a big drawdown. And so over the long term, you end up at the same place, but you don't have the ups and downs, and you can sleep a bit easier at night.
Thanks very much. That's awesome. Thank you, Sean. And that's a really, really great segue into markets as well. So we're going to kind of move on from taking that macro view of markets and how we're looking at and managing the money, and now really think about what does it mean for our members and investors every day. So we know that today people are they're delighted by the returns that they get, but they do worry about the economy. They worry about what's going on with tariffs. They worry about what's going on around the US. But equally, they're excited about the future ahead for them. So, Marcus, when you think about it from your perspective and bringing in that really client-centric view of things, how do you help people and advisors stay calm when they're going through these times when you know all of the right things to do, but sometimes we can just be scared to do the right thing?
Yeah, thanks, Sharon. And thanks everyone for joining us at lunchtime. Look, that's a really good question. And I do spend a lot of time talking to our advisors about this and equally to clients. It's really as simple as not getting too worried if nothing for you has changed. So it's awesome to attend something like this and hear from someone like Sean and get some confidence in who's managing that money for you on your behalf in your KiwiSaver account. But if your time horizon hasn't changed, and Sean mentioned this too, or your goals haven't changed, or nothing in your life has drastically moved, then largely nothing should be done. Okay, and it sounds a bit kind of counterintuitive to what you want to do. The media loves to write bloodbath headlines, and we see it often. And on your behalf as clients, don't worry. I send messages to Sean, go, hey, what's going on with this bloodbath? And he'll say, calm down. And that's exactly what we want you to do. The media will pick up a singular thing often and blow it into a big headline, because that's what gets us all clicking on those stories. Great, read them. I'm fascinated by all sorts of different things that happen around the globe. But when it comes back to my personal KiwiSaver account, I just look at it and think, yeah, but I made a good decision. I sat down with an advisor. I discussed where I was going, what my path was, where I wanted to end up, and that hasn't changed. So if that hasn't changed, then I don't need to do anything. And I once heard a very wise CIO like Sean, and I'd be surprised if Sean hasn't said this to someone. A really good thing to do is to have a little book or something like that. You write down what you're trying to do and why you invested the way you did, and go and put it away in a drawer. When those things start to make you feel a bit panicked, when you start to feel nervous about, hey, maybe I shouldn't be in a growth fund, I'm reading all this stuff, the markets are going to collapse, go back to that little book, read about what you said to yourself as to what your purpose, what your drive was for the outcome that you wanted. Ask yourself, did it change? If it didn't, then just carry on, keep investing.
That's great. Thanks very much, Marcus. One thing that does come up from time to time, though, is this whole principle of people that believe that they can time the market. So everyone thinks that they can identify the right opportunity to come in and the right opportunity to then try to preserve what they might have built up and exit. What would you say to anyone that might be thinking about doing that?
Don't. Yeah, look, staying in the market, staying exposed to the market is the most important thing. We absolutely saw this during COVID, where the market started to tip over and take a pretty steep dive down. And there were plenty of people who tried to, what you'd say, outrun the market. Now, this may not be something that ever happens again, but in that particular instance, but the drawdown was very steep. What we saw people doing was trying to outrun the market by moving to conservative on the way down. Now, something to bear in mind is KiwiSaver, it's not an in and out. It takes a while. When you make a change, we have to wait for every market around the world to close before we know what your unit price is in order to move you. And what people then tried to do is move again before we had even got them out of the last thing. Now, it's just a terrible idea. If you miss the best days in the market, you will miss a huge amount of upside over the long term.
Just on that point, Marcus, there's a study that did use the US market as a case. Over 20 years, if you missed 10 days out of that 20 years, your return was half of what you would have got if you remained in the market. So the impact is incredible.
Yeah. And when you think 10 days, and in KiwiSaver as a product, the amount of time it takes to make shifts is actually reasonable. It's not one day. So, it really is about staying the course. And if you're worried or nervous during any of these things, this is why we believe so much in advice. All of our clients have had advice on the way in, and they have continued access to that advice. A lot of you have advisors who you have a personal relationship with. You have their number, their email address. And if you don't, let us know. We'll reconnect you to your advisor who helped you into Aurora. And that person is there as a sounding board, as are we. Okay. And the thing that we will spend most time talking to you about is, has something changed? And if it hasn't, then let's just think about this, take a deep breath, and keep going forward.
Fantastic. Thanks, Marcus. One question, Sean, for you just to think about and maybe come back to. You raised kind of when you're having a bit of a chat that AI is just not that environmentally friendly. Can you expand on that a little bit? Because I'm not sure people have ever really kind of thought about the context of AI and what it takes to run all of the stuff.
Yeah, so there's been some various research done on it, but basically, and this is, I don't know how, validated it is, but 50 questions on ChatGPT use as much power as required to power a house in 24 hours and up to 6 liters of water. Technology is improving though, like NVIDIA new chips are far more energy efficient. They're starting to figure out how to circulate water. But nonetheless, at a time when the globe needs to decarbonize and electrify everything, we've got this massive demand for power. So, it's the argument being that the AI purists argue that AI is going to solve the climate change problem because of these models and stuff. They can solve this. So there's a debate there. But in the near term, I worry that all this power is going to this tool, that while it's going to be it is going to impact on the world, is it going to offset the potential risks of the environmental impact? So yeah, it's just something to. So as I said, if you have a simple question, use Google. Don't use ChatGPT.
Save it for the big stuff.
Yep.
It is phenomenal how fast this has grown and developed. I think you see ChatGPT, Gemini everywhere and being used in everything these days. No doubt it makes it easier, but the consumption.
Yeah, but also, there was that case over here, Deloitte did that government report where they call them hallucinations. It was made up research papers and stuff, and it was a real, Deloitte came out of it looking very, very bad. So it's actually, I saw Huang, the NVIDIA CEO, got challenged yesterday because Amazon just laid off 14,000 people on the back of AI, and there's AI coming for a job. But he goes, no, a person using AI will be better than a person not using AI, but you still need that person with AI AI can't replace the person.
It's there to support the person, not replace them.
Yeah, a human and artificial intelligence are better than either or.
Yeah, absolutely. Marcus, if I can maybe hand over to you as well. We'll start to kind of wrap up in the next couple of minutes, but I wondered if I could maybe just throw you in the hot seat to just do a little bit of a recap on some of the budget changes that come up for next year, so that we're kind of starting to think about Christmas already. That for me is slightly terrifying because it doesn't feel like Christmas time yet, but it is just around the corner. And then after that, we start to hit 2026 with a number of changes that start to come in for KiwiSaver. I think they're really important and they're really valuable changes, but also just helpful to remind people.
Yeah, thanks, Sharon. It wasn't written in the questions for me
I
to
know.
make sure I knew the answer to. That's okay. Look, I think, yeah, I'm gonna validate this with you. But look, I think I'm gonna simplify this a little bit. And we see often, well, not often, but we've seen enough times governments change settings on KiwiSaver. I think this time it's positive. We're increasing contribution levels. So next year we go up by 0.5%, and the year after we go up by another 0.5%. Now, what does that actually mean to you? It doesn't mean you need to do anything. That's the thing I want you to go away and remember. When settings are adjusted on KiwiSaver, they invariably take effect at the end of a KiwiSaver year. You don't even need to know when that is. You just need to carry on contributing to your KiwiSaver. And what is going to happen over the next couple of years is the contribution levels are slowly rising. And what does that mean to you? It means at the end, you're going to get to a better place with your investment. What I would stress to you is it's still not really enough, in my opinion, for most people. Actually, I see now I'm going to throw a curveball back at you, Sharon. Here we go. I'm going to try and share something. I wasn't planning on doing slides, but I did practice in case I needed to. I'm just going to throw Chrome tab, this one. There, let's see. Does it work? Yes, it does.
Yes.
This is a slide that we our advisors use, and it talks to what a no frills or a choices retirement will look like, and the gap that you'll have to fund that potentially. Now, what I want you to focus on is the actual numbers. Look at what we believe a no frills or a choices lifestyle is in a weekly. Now, I don't think that's enough. I personally, when I get to my retirement, feel like I'm going to want to have more than that. So what that really means in simple terms is you just need to continue to do more as you can. Now, I know it hurts right now. Everyone is hurting. The cost of living in New Zealand has been really hard. Gosh, we've all just come out of winter where our power bills, I don't know about you, Sharon, but I mean, whew, I had a few months there where, I was starting to consider whether baths and showers were a great idea. It was so expensive. Okay. However, we still need to think about the future. And when is a good time to do that? Well, when things change. So perhaps you have a student loan and you get into the tail end of it. Good on you. When you get that 12% back in your paycheck, don't take it all. Take some for you now and leave some for future you. Okay. So maybe think about increasing your contribution rate up to 10%, and then you'll still get a pay rise, but you will make a material difference to the end at retirement. Another time to think about that is if you were lucky enough to get a pay rise. I'm not sure many of us will be getting a pay rise anytime soon with the state of things. However, if you do, albeit it's a 2% pay rise, think about adding 1% to your KiwiSaver and taking 1% for you now. It's a mentality change, a psychology change. Think about a little for me now and a lot for me later, because a little now has a compounding huge difference in the future. So they're the key differences coming at us. So the contribution rates go up. And of course, the other thing that is happening is that the government contributions is essentially slowly going away. So I think we can assume over time that that will subside altogether. But don't worry about it. keep contributing. Do not get off the KiwiSaver train.
Absolutely, absolutely. Look, I think I'd probably wrap up that, and also some of the things that Sean was talking about. There are kind of for people that are investing in KiwiSaver and building their future nest egg through KiwiSaver, there's 3 critical rules really that drive what you end up with at the end when you get to retirement. So the 3 rules are what you contribute. So the amount of money that you put in, the contribution rate that you set to contribute at, has a massive bearing on what you have at the end of the day. The investment fund that you choose to invest in has a massive bearing on where you'll be at the end of the day. And the third one, the timeline or the time frame you have between starting to invest and then using your investment, also probably arguably has the biggest bearing on what your retirement balance will be. I think we're going to wrap up in a minute, but what I would do is also say to people, just take a minute, take a breath, don't look at your balance too often. Think about it as the future. It is the future. What you're doing today, the decisions you make today, for what occurs in the future. So keep your eye on the ball for later, not so much the eye on the ball for what's happening in markets today. Markets will always be here. Markets will go up and they will go down. I think that's probably the only truth in life, aside from we're all going to pay taxes. I'm not
And
I'm not sure, Sean or Marcus, if there's anything else you just want to add before we wrap up today.
No, it's good. Thank you. Thanks for your time, everyone. Appreciate it.
The one thing I'll just add on the back end then, Sharon, is something to think about. I agree, don't look at your balance too often, but I want you to all go away and also think about that moment. There's a key moment in every KiwiSaver, every one of our journeys with KiwiSaver in our account, and that's when your returns start to go. It will be a bigger part than your contributions. And it's an exciting time, and KiwiSaver as a whole, for all KiwiSavers in New Zealand, has gone past that point, which means if we all stop contributing today, it would continue to grow. And in your own personal account, just push on through, because you get to that point too, and then you just watch your KiwiSaver balance just do this massive hockey stick. So it's exciting. Keep on, I can't say it often enough, keep contributing. Do not stop contributing.
And hold your mirror. So hold tight to what you're doing. Don't get worried about markets. Sean is more than worried for all of us, and making those decisions every day, which I think
I got no hair.
That does let me sleep a little bit more at night. I don't know, that's why you have no hair. Thanks very much for joining everyone today. We will get out this video to everyone as well. If you do have any questions that pop up from time to time, please do not hesitate to email us. We would love to hear from you. Once again, thank you so much for sharing your time with us today.
Thanks everyone.
Bye-bye.
Thanks, Sharon.